Chapter 8. Fintech, Financial Technology, and DeFi, Decentralized Finance. Exploring financial inclusion through Fintech. Financial technology, or Fintech, plays a pivotal role in modernizing and streamlining financial services. It integrates advanced technologies to enhance the efficiency and accessibility of financial transactions for businesses and individuals. Initially confined to back-end systems of established financial institutions, Fintech has rapidly evolved to encompass consumer-centric services across various sectors, such as education, banking, and investment management. The term Fintech emerged in the early 21st century, primarily describing technological advancements within traditional financial institutions. However, in recent years, there has been a notable shift towards consumer-oriented services. Today, Fintech permeates diverse sectors, including retail banking, fundraising, and investment management, reflecting its expanding role in shaping modern finance. The rise of cryptocurrencies and DeFi. In addition to traditional financial services, Fintech also encompasses the development and utilization of cryptocurrencies like Bitcoin. Although cryptocurrencies garner significant attention, their financial impact remains rooted in the traditional banking industry, which boasts substantial market capitalization. Emerging technologies like decentralized finance, DeFi, aim to challenge the dominance of banks by leveraging blockchain technology to decentralize financial services. Since the advent of the Internet revolution, Fintech has experienced explosive growth, becoming an integral part of daily life for many individuals worldwide. From transferring funds via smartphones to managing investments online, Fintech innovations have transformed how people conduct financial transactions, fostering greater convenience and accessibility. Consumer adoption and innovation. According to ICE 2019 Global Fintech Adoption Index, a significant majority of consumers now utilize multiple fintech services, underscoring the widespread integration of fintech into daily routines. Notably, successful fintech startups aim to challenge traditional financial service providers by offering superior services, catering to underserved populations, or providing faster, more agile solutions. Fintech presents a promising solution for individuals with limited access to traditional financial services, particularly in developing regions. By leveraging deep data analysis and innovative approaches, Fintech companies offer alternatives to traditional banks and microfinance institutions, empowering underserved populations with access to credit and financial opportunities. Optimizing Fintech with blockchain technology. Despite the convenience Fintech solutions offer, they often face challenges rooted in centralized power dynamics and lack of trustability. Blockchain technology addresses these issues by introducing decentralization and transparency. Users no longer need to rely on authoritative approvals, as blockchain ensures transaction processes are transparent and immutable, promoting trust among users. Moreover, blockchain significantly streamlines transaction processes, reducing dependencies on third parties and making transactions public. This efficiency not only enhances user satisfaction but also contributes to a more robust business economy. Operational costs, a critical factor in the competitive fintech market, are substantially reduced with blockchain technology, highlighting its economic impact within the sector. Transitioning from challenges to solutions. Blockchain-driven decentralized finance, DeFi, plays a significant role in revolutionizing banking and peer-to-peer, P2P, payments. Traditional banking setups, fraught with inefficiencies, find relief in blockchain's decentralized system, offering faster transactions and potential savings for large investment banks. Additionally, blockchain addresses issues with existing payment systems, such as high processing fees and security concerns, while facilitating more efficient international payments. In the world of trading and trade finance, blockchain integration liberates traders from exhaustive paperwork and convoluted processes. Blockchain's efficiency expedites settlements, reduces risks, and enhances trade accuracy, benefiting both traders and financial institutions. Similarly, crypto lending introduces a novel approach to lending, leveraging crypto assets as collateral to secure fiat-based or stablecoin loans. showcasing blockchain's transformative potential in financial services. Regulatory compliance, a critical aspect of the fintech sector, is also streamlined with blockchain technology. Fintech companies utilize blockchain to upgrade regulatory compliances, track verified transactions, and ensure the integrity of records for financial reporting and audits. The auditing process, traditionally complex and slow, finds efficiency with blockchain, simplifying data verification and contributing to the overall efficiency of financial operations. Social FI, bridging social media and decentralized finance. Social FI represents a groundbreaking concept that merges the functionalities of traditional social media platforms with the principles of decentralized finance, DeFi, embodying a transition towards Web3. At its core, Social FI embodies a fusion of social media and DeFi principles, liberating users from the influence of centralized authorities that govern conventional platforms. Empowerment of content creators lies at the heart of Social FI. Unlike the prevailing Web 2 model, where platforms often monopolize the value generated by user-generated content, Social FI ensures that creators are fairly compensated for their contributions. This democratization of content creation encourages an environment where creativity flourishes, unrestricted by corporate interests. Decentralized autonomous organizations, DAOs, and social tokens are integral to Social FI platforms, serving as governance backbones and monetization tools, respectively. DAOs prioritize community governance, fostering trust and transparency, while social tokens enable content creators to monetize their interactions beyond traditional advertising revenue. Monetization within Social FI ecosystems revolves around social DeFi tokens, offering diverse earning opportunities and fostering vibrant relationships between creators and audiences. Through affiliate programs and token-based incentives, Social FI platforms catalyze community participation and reward active engagement, enhancing user agency and interaction. Digital ownership is a pivotal aspect of Social FI applications, facilitated by technologies such as PFP NFTs and content-based NFTs. These innovations empower creators to authenticate their identity and monetize diverse forms of content, promoting a more equitable distribution of advertising revenue. The fundamentals of DeFi, revolutionizing financial technology. Decentralized finance, DeFi, represents an innovative financial technology that relies on secure distributed ledgers, much like those seen in cryptocurrencies. In the United States, the Federal Reserve and the Securities and Exchange Commission, SEC, establish the regulations for centralized financial entities such as banks and brokerages, which serve as direct avenues for individuals to access capital and financial services. DeFi seeks to disrupt this centralized financial framework by granting individuals the ability to engage in peer-to-peer transactions, thereby challenging the dominance of traditional financial institutions. The essence of decentralized finance, or DeFi, lies in the utilization of emerging technology to eliminate the involvement of third parties and centralized entities in financial transactions. Comprising cryptocurrencies, blockchain technology, and accompanying software, DeFi empowers individuals to conduct financial transactions directly with one another. Despite its potential, DeFi remains in its early stages, susceptible to vulnerabilities such as hacks and thefts attributed to inadequate programming and insufficient security testing prior to application launches. Decentralized finance, DeFi, operates through peer-to-peer financial networks, utilizing security protocols, connectivity, software, and hardware advancements as its foundation. By circumventing intermediaries like banks and other financial service providers, DeFi eliminates the fees typically associated with utilizing their services. In the prevailing financial landscape, such fees are deemed indispensable for the system to operate smoothly. DeFi harnesses blockchain technology to minimize reliance on these intermediaries, thus enhancing the efficiency and cost-effectiveness of financial transactions. Decentralized finance, DeFi, encourages an ecosystem where individuals can engage in financial activities without the need for intermediaries, thus democratizing access to financial services. By leveraging decentralized networks, Individuals can lend, borrow, trade, and invest without relying on traditional financial institutions. Moreover, the absence of intermediaries reduces the potential for censorship or discrimination in financial transactions, promoting greater inclusivity and transparency within the financial system. One of the key features of decentralized finance, DeFi, is its potential to revolutionize traditional financial systems by introducing greater efficiency and accessibility. Through smart contracts, automated processes, and decentralized governance mechanisms, DeFi offers a more streamlined and accessible alternative to conventional financial services. Additionally, DeFi protocols enable participants to access a wide range of financial instruments and services, including lending, borrowing, trading, and asset management, all within a decentralized and permissionless environment. DeFi applications play a pivotal role in facilitating financial activities on the blockchain, acting as intermediaries between individuals and decentralized networks. These applications enable a plethora of financial transactions, including purchases, loans, gifts, and trading, all without the involvement of traditional third-party institutions. They are essentially user-friendly programs that can be installed on various devices like personal computers, tablets, or smartphones, significantly enhancing accessibility to decentralized finance. Without these applications, users would need to navigate through more complex command line interfaces, potentially limiting the adoption of DeFi by those less familiar with technical processes. Through DeFi applications, users are provided with intuitive interfaces that automate transactions and offer a range of financial options. For instance, if someone wishes to extend a loan and charge interest, they can easily set up the terms within the application's interface. Similarly, individuals seeking loans can browse through available options, which could range from traditional banking institutions to peer-to-peer lending platforms, and negotiate terms directly within the application. This seamless interaction streamlines the borrowing and lending process, fostering greater efficiency within the decentralized finance ecosystem. Moreover, some DeFi applications feature matchmaking functionalities that connect users based on their specific financial needs and preferences. Leveraging the global nature of blockchain technology, individuals can access financial services from anywhere in the world, further democratizing access to decentralized finance. This global reach expands the pool of potential lenders and borrowers, increasing opportunities for financial inclusion and innovation on a global scale. While DeFi transactions offer a degree of privacy by omitting personal identifiers, they are still traceable by entities with the requisite knowledge, such as governments and law enforcement agencies. This traceability serves as a necessary safeguard, ensuring accountability and protection for individuals' financial interests within the decentralized finance space. Thus, while DeFi applications provide unparalleled accessibility and convenience, they also uphold essential principles of transparency and accountability in financial transactions conducted on the blockchain. Decentralized finance, DeFi, accessibility, affordability, and security. Decentralized finance, DeFi, makes financial transactions accessible to anyone with an internet connection. For example, someone in Nigeria can lend cryptocurrency to a borrower in Brazil without needing approval from a bank or financial institution. This accessibility allows people worldwide to participate in financial activities without facing geographic barriers. In DeFi, individuals can negotiate interest rates directly, leading to lower fees compared to traditional banking systems. For instance, if Alice wants to borrow cryptocurrency from Bob, they can agree on an interest rate without involving a bank. This direct negotiation reduces fees and increases the potential for higher interest rates for both parties involved. DeFi relies on smart contracts stored on blockchains, ensuring security and transparency in transactions. Imagine a smart contract as a digital agreement between two parties, once agreed upon and stored on the blockchain. The terms of the contract cannot be altered. This transparency allows anyone to review the contract's details without revealing personal identities, enhancing trust and security in DeFi transactions. Peer-to-peer lending in DeFi enables individuals to lend and borrow cryptocurrency directly from each other, For example, Sarah in India can lend Ethereum to David in the United States without going through a traditional bank. This direct interaction between peers eliminates the need for intermediaries, providing borrowers with access to funds and lenders with investment opportunities across borders. Disadvantages of DeFi. Decentralized finance, DeFi, operates in a largely unregulated environment, leaving it vulnerable to various risks. Unlike traditional financial systems, DeFi lacks clear regulatory frameworks to govern its operations. This regulatory vacuum raises concerns about investor protection, financial stability, and compliance with anti-money laundering laws. For example, DeFi's borderless nature complicates jurisdictional issues, making it challenging to determine which regulatory authorities have oversight. The decentralized and cross-border nature of DeFi transactions poses significant challenges for regulatory enforcement. In cases of financial crimes or regulatory violations, determining responsibility and enforcing regulations becomes complex. Questions arise regarding who should investigate and enforce regulations, especially when transactions occur across multiple jurisdictions and DeFi protocols. Additionally, the lack of centralized intermediaries in DeFi makes it difficult to hold parties accountable for illegal activities. In response to growing concerns about the regulatory oversight of DeFi, regulatory authorities have begun taking action against non-compliant projects. For instance, the U.S. Commodities and Futures Trading Commission, CFTC, filed charges against 3 decentralized exchanges, DEXs, for violating commodity trading laws. These charges included operating without proper licenses, failing to register as designated contract markets, and violating anti-money laundering regulations. The charges against the 3 DeFi protocols highlight the legal risks associated with operating in the decentralized finance space. Companies found to be in violation of regulatory requirements may face significant penalties, including fines and cease and desist orders. In the case of Open0x and DerideX, the CFTC imposed civil monetary penalties ranging from $100,000 to $250,000 for various regulatory infractions. The regulatory actions taken by authorities have implications for DeFi operators and the broader ecosystem. The penalties imposed on the 3 projects serve as a warning to other DeFi platforms about the importance of regulatory compliance. Additionally, the charges underscore the need for DeFi operators to carefully assess and adhere to legal requirements to avoid facing similar consequences. Some DeFi operators may mistakenly believe that transactions facilitated by smart contracts are exempt from regulatory scrutiny. However, the CFTC's actions demonstrate that smart contracts do not absolve platforms from compliance with existing regulations. While smart contracts automate transactions, they do not shield operators from legal obligations or regulatory oversight. As the DeFi landscape continues to evolve, regulatory authorities are adapting their approaches to address emerging challenges. The CFTC's enforcement actions signal a proactive stance in regulating DeFi activities and ensuring compliance with existing laws. However, regulatory frameworks for decentralized finance are still in development, requiring ongoing collaboration between industry stakeholders and policymakers. The CFTC's commitment to enforcing regulations in the DeFi space underscores the importance of vigilance in addressing regulatory compliance. Despite the decentralized nature of DeFi, regulatory authorities are actively monitoring activities and taking action against non-compliant entities. This enforcement vigilance aims to maintain market integrity, protect investors, and mitigate systemic risks associated with decentralized finance. Decentralized lending protocols, Aave, Compound, and Maker stand as the primary DeFi lending protocols, collectively holding billions of dollars in their smart contracts. These platforms offer a straightforward concept. Users can either lend out their cryptocurrency tokens or borrow them. Importantly, these protocols are non-custodial, meaning that the creators of the platforms do not control users' holdings. Users can engage with any ERC20 token on these platforms, as they are all based on Ethereum. These lending protocols gave rise to the phenomenon known as yield farming. In June, Compound introduced $Comp, a governance token that allowed holders to vote on network operations. Users who lent cryptocurrency on Compound earned $comp as rewards, akin to loyalty points, which they could use for voting on network proposals or for speculative purposes. The introduction of $comp sparked widespread attention, leading to a surge in its value within days. Speculative use of governance tokens. Beyond governance, $comp and similar tokens became subjects of speculation due to their substantial price appreciation. For instance, $comp's value surged from $64 on launch day to $346 within a week. This trend prompted other lending protocols to follow suit, issuing their governance tokens. Notably, the governance token for Yearn Finance, $YFI, saw its value soar to $41,000, nearly quadrupling the price of Bitcoin at the time. This remarkable growth occurred despite its creators initially stating that the token had zero value and encouraging users to earn it rather than buy it. Decentralized exchanges, DEXs, represent another prominent category within DeFi protocols, with Uniswap emerging as the largest among them. By August 2020, Uniswap had surpassed centralized exchanges like Coinbase in daily trading volume, marking a significant milestone for the decentralized finance space. Other notable DEXs include Balancer, Bancor, and Kyber, with 1inch serving as an aggregator for multiple decentralized exchanges. DEXs operate using automated market maker, AMM, models, distinguishing them from traditional exchanges like Binance or decentralized exchanges like IDEX. Unlike these platforms, which rely on order books and matching buyers with sellers, AMMs utilize liquidity pools to facilitate trades. Liquidity pools consist of token pairings, such as ETH and BTC, where traders can access funds to execute trades. The presence of sufficient liquidity in these pools ensures smooth trading experiences for users. High liquidity in a market indicates ease of trading, while low liquidity poses challenges in finding buyers for tokens. Liquidity pools, comprising substantial reserves of token pairings, enhance market liquidity and enable seamless trading experiences. The non-custodial nature of DEXs allows for the inclusion of any ERC20 token, providing users with a broader array of trading options compared to centralized exchanges, which may omit certain tokens due to regulatory concerns or suspicion of fraudulent activity. Participants who provide liquidity to these pools earn fees from trades, in addition to potential yield farming rewards offered by some protocols. This incentive structure not only encourages liquidity provision but also contributes to the overall growth and sustainability of decentralized exchanges within the DeFi ecosystem. The world of decentralized finance, DeFi, offers alternatives to centralized synthetic assets, addressing concerns regarding trust and transparency. While centralized stablecoins like Tether dominate with approximately $24 billion in circulation, issues surrounding transparency and accountability persist. For instance, Tether has faced scrutiny regarding its claims of being fully backed by the US dollar, with investigations by the New York Attorney General underway. Decentralized stablecoins, such as DAI produced by Maker, operate on self-sustaining algorithms to maintain their peg to the asset they represent. Unlike centralized stablecoins, which rely on trust in issuing companies, decentralized stablecoins derive their value from algorithmically governed mechanisms. This approach aligns with Lawrence Lessig's concept of code as law, emphasizing the importance of algorithmic governance over human trust. Platforms like Synthetic facilitate trading of synthetic assets, including synthetic US dollars, Australian dollars, Bitcoin, and gold. These synthetic assets enable users to gain exposure to various financial instruments without directly holding the underlying assets. Synthetic also plans to introduce trading for stocks, ETFs, and indices, expanding the range of available synthetic products within the DeFi ecosystem. Wrapped Bitcoin, WBTC, provides a bridge between Bitcoin and Ethereum, allowing Bitcoin users to participate in DeFi activities. By depositing Bitcoin into WBTC contracts, users receive equivalent WBTC tokens that can be utilized within the Ethereum ecosystem. WBTC operates as a custodial product, with BitGo, a Goldman Sachs-backed crypto firm, serving as the custodian. However, non-custodial alternatives are under development, offering users greater control over their assets within DeFi protocols. GameFi, the intersection of gaming and decentralized finance. GameFi, also known as game finance, represents an innovative fusion of online gaming and decentralized finance. It introduces the concept of play to earn, P2E, wherein players have the opportunity to earn digital assets and rewards through in-game activities. Central to GameFi is the integration of blockchain technology and non-fungible tokens, NFTs, which aim to grant players sole ownership over their in-game assets and currencies. By leveraging blockchain, GameFi seeks to create an immersive gaming experience while also providing avenues for financial compensation to players. At its core, GameFi operates on the principle of rewarding players for their gaming achievements and skills. This model has given rise to a new category of gaming experiences known as play-to-earn games. Within these games, players can earn various rewards, including digital tokens and in-game assets such as virtual land, avatars, weapons, and costumes. Notably, these in-game assets often take the form of non-fungible tokens, NFTs, which are unique digital items that can be traded on blockchain-based marketplaces. Each GameFi project employs its own unique economic model, contributing to the diversity of experiences within the ecosystem. Blockchain technology serves as the backbone of GameFi, powering both the games themselves and the in-game tokens and assets. Smart contracts, a key component of blockchain technology, facilitate the decentralization of many aspects of the gaming experience. Decentralized finance, DeFi, NFTs, and play-to-earn mechanisms further enhance the functionality of GameFi, creating open and sovereign in-game economies. By utilizing blockchain, GameFi aims to democratize ownership of digital items and currencies within the gaming ecosystem. While the emergence of GameFi presents exciting opportunities for players in the gaming industry as a whole, it also poses certain challenges. On the positive side, play-to-earn models offer an alternative to traditional pay-to-play gaming models, potentially increasing earning opportunities for players. Additionally, the rise of NFTs promotes the concept of virtual asset ownership without centralized control. However, challenges such as maintaining a balanced in-game economy and managing market volatility remain. Despite these challenges, market forecasts suggest significant growth potential for GameFi in the coming years, with the industry potentially reaching over $100 billion. As GameFi continues to evolve, its impact on decentralized finance, NFTs, and the broader gaming landscape will be closely monitored.